Okie dokie. Well, tonight we're going to kind of move further in our current lesson series into another technical trading / charting technique. We're going to talk about swing points. Swing points is actually one of the most easy to identify type things. Basically, it's marking visible up and down moves. Me personally, I don't trust wicks on candles. Why? Because the stock market's open 6.5 hours a day. Last I checked, there's 24 hours in a day. So for 6.5 hours, the prices on stocks are constantly bebopping and moving. And for 17.5 hours, one price is seen around the world. Tomorrow, when you log into your brokerage account and you look at your watch list, it'll tell you if stocks are up and down based on what price. The closing price from the day before. That right there alone is your most simple indication of the importance of the closing price of a candle, whether it be a weekly candle, a daily candle, a 1 hour candle, 30-minute candle, a 15-minute candle, a 10-minute candle, a 5-minute candle, 3-minute, 2-minute, 1-minute. The closing price of that candle will have more effect on the technicalities of your trade than anything a little wick might do. Now, swing point trading is very, very simple. It's about identifying up and down moves and whether the time it just went down was further down than it went last time, or if the up move it just made was further up than the last time. Does that make any sense? It's basically a game of identifying up and down moves and whether you're making lower lows and lower highs or higher highs and higher lows. Now, as an options trader, swing points can be a really good tool, even though they are linear. They are linear in the sense that it's all based on horizontals, right? It's not like a channel where, hey, as long as I'm in this channel, every minute that goes by, I should have a higher stop or a lower stop, whatever, depending on if I'm going an up or down channel. It's not like a Fibonacci extension that projects in a nonlinear fashion a price based on replication of movements. With swing points, it's a whole bunch of sideways lines. That's what horizontal means. And for options traders, that can be a very good thing to identify why. Why can it be a good thing to identify? That is very, very particular to options. You won't make any money when, flyer. When stocks go sideways, options lose money because with options, you're not just trading like a common stock trade where it's basically you got all the time in the world, but it's the price that matters. With options, it's not only the price of the stock that matters, it's the time that you're holding the trade. Now, one thing you guys hear me say often when it comes to options trading is options are a game of what? What is a critical value is in stock price movement? $1 moves. Options are a game of $1 moves. And why do I say that? Well, when you look at your options chain and you see like delta, gamma, all that kind of crap, that stuff's all based on an assumption as if the stock were to move $1. All the mathematical and algorithmic factoring is based on a $1 move. So when you talk about swing points, it would be probably pretty safe to say that if there's less than how much space between your horizontal lines, that you should not be looking to make a trade. Less than $1. That will protect you. Now, can you make money if a stock moves 20 cents? Yeah, probably. But you know what? To me, Apple moving 20 cents and the 5 to 10 cents max I'd probably get on an options trade is not worth the risk of even making the options trade. Let's face it, when you make an options trade, if you're not right, especially when it comes to your shorter term trading, if you're not right, does a 10-cent win pay for what your loss could be if you spend $1 per contract? So some people with lesser knowledge of how trading works would say that maybe Coach Mike's a little bit greedy in how he trades because I will forfeit the opportunity for small wins. I look at stocks all the time and I'm like, oh, wow, I could probably make 15, 20% on that options trade or that options trade. And then I say, but that's not good enough for me. And there's a reason it's not good enough for me. Because I have a history of trades that go much larger than that. We're not talking about a Jeff Williams saga story where one time he might have alerted something that actually did something special that he didn't tell people to sell at a 10% gain. We're talking about something where somebody's got a very healthy amount of time of a proven and published history. So where really I get disappointed for any profit under 100%. I really do. That is a truthful statement. If it's under 100% profit, I'm disappointed. I expect better. Will I take it? Yeah, I'll take it. Will I be happy about it? No. It's just another thing to me in that type of situation. So, you know, if you're at least trading opportunities that even give you an ability to make that kind of return, yes, you will forego several opportunities to make piddly little gains so that you can focus on opportunities that regularly make or regularly have a higher potential or larger gains. So tonight we're going to talk about swing points, and the chart that I'm using here is actually a very effective chart for swing point trading. This chart here is commonly referred to as a mountain chart. It's a mountain chart because it kind of looks like the Rocky Mountains, doesn't it? Now, for people that struggle with identifying swing points, I'm going to have to say this is probably the chart you should be using. Now, I also want to say before I confuse anybody, everything that I say tonight about swing points does not necessarily have something to do with our 50-50 trading system. We are talking about swing points, not the 50-50 trading system tonight. Does everybody understand that? Okay. So when you're talking about swing points and trading swing points, oh wow, I'm going to have a heart attack. I called Nikki out on Facebook and she actually showed up to the webinar. Anyway, swing points. Very, very simple. It's marking the high and low points of visible up and down moves. Not one candle up, one candle down, and hey, that moved. So let's look at something. Would you say, and we're going to start basically right down here, but would you say on this chart that this all down to here is one visible down move? If you said yes, I'd probably have to agree with you. Now, for me, with swing points, if your broker will allow you to change the color of your lines, it can be very helpful because at some time, a swing point on your chart might not be visible as to where that swing point started. As a matter of fact, on a 15-minute 5-day chart, which is the chart I'm showing right now, tomorrow, the source of this line will not be visible. So for me to color code it red like this tells me it's a swing low. Now, do you see how this kind of came up here, kind of made a little shark tooth and then popped up again? Is this little shark tooth really a visible down move? Or is this entire move, even to the second point, a visible up move? And therefore, like right here, I would be coloring this one green. Now, at this point, to make things just a little bit easier, I'm going to change the time frame of this chart to 10 days, 15-minute, but I'm going to zoom it. And we are just going to go back to this area here. Now, the one thing that's important for people to understand with swing points, and just to quickly answer literally about 15 private messages I've gotten, I will spend a little bit of time afterwards talking about correlating the 50-50 trading system into swing points. That way we don't have to ask questions about 50-50 trades during the webinar. When you are watching the chart develop, just because you see the stock maybe start to go up a little bit, does that mean that it's making now a visible up move? Like right here at this point on the chart where it kind of came down and one time frame later, it's up a little bit. Is that giving me enough data to determine that it is now making an up move? Absolutely not. As a matter of fact, most of the time, you should not be marking a higher low point until, like for a low point, heck, you'd already be really close to this next high before you're actually putting a mark at your low point, because then you've visibly seen a move. Now here we're 2 to 3 points into the time frame, and we're already actually starting to curl downwards. And now we could say, hey, that was there a visible up move. Would you agree? That right there so far was a pretty visible up move now. It wasn't just one time frame. It moved up for a few time frames. So I go ahead and mark the swing low. You notice I didn't mark the swing high. See, especially when it comes to options trades, about 90% of the time, the worst thing you can do is try to buy the absolute low or the absolute high of any move. Quite literally about 90% of the time. Why? Because when it makes that lower high, it usually does what for a little bit? Goes sideways, double tops, double bottoms, all these kind of things. And those things take what? Those things take what to happen? Time. And if we're talking about options trading, is time something we have? We don't have time. We can't give time. Time costs money. And therefore, it's really not hard to assume at all that your better options trades will come when the stock does what? Not when the stock makes its absolute low. On the breakout. There you go, Moss. momentum trade situations. The reason I say that, let me give an example. Today we were talking about Apple in the chat room, and somebody said, man, it's holding that 129 that kind of hit it twice on a tick chart or something. It must have been like a half-second chart that it hit it twice. And even though it did kind of hold that, it made a quick dip. And then when it came back to pretty much the exact same price the person was talking about, the 130 calls were 11 cents cheaper. Now, somebody could say, well, we could have just held and made that money back. Yes, but you can't always just hold a bad entry and make the money back. Sometimes you don't get lucky. So be a little bit patient to let things develop. Now here, as the stock started going down, it came right off this last line that I had marked, and it starts moving up a little bit. Looks like a double bottom. What should I be doing with my chart at this very instant in time? We made a visible down move now. I want to mark the swing high. Now, already based on something I mentioned right at the start of our session tonight, you should be identifying something that I commonly talk about in the chat room. What would you say that you're identifying right now? Okay, besides a W pattern. I knew everybody would say that. A very tight horizontal range. Because remember, even on a W, your target's the highest close at the start of the fall. And if you're just using a mountain chart, you would just use this top line. And even between your double bottom here and your top line here, is there a $1 move right there? You know, today there was a period on the SPY that I said, so long as the SPY is between these two lines, it's really in a zone that you should not trade it. It kind of went up to one of the lines, it pulled back about halfway, it trickled around for about an hour and 15 minutes, and then it broke above one of the lines. And it gave an opportunity for shorter term traders to trade it. And in an opportunity where the premiums on the calls had actually kind of reset themselves and give you the ability to make money, where as it was not doing anything bullish, the premiums were just not really doing anything. They'd fall when it came down, but they wouldn't really go up when it started going up. And to trade the breakout trade would have given you the higher probability at a profitable trade. So right now on this chart, and I know we're using the 15-minute chart, but in all reality, this applies to any time frame chart. This system's not something specific to just the 15-minute chart. If it's a daily chart, I'm sure you can still identify visible high and low points. Now, because we're in quite a tight range here, should we even really be looking for a trade right here? You know, there's a few assumptions that we need to make as traders. The average Joe trader comes into the market and all of their assumptions make them buy something. And that's why 90% of people fail. The assumptions you should make for trading should be something that prevents you from buying, so that when your assumptions fail, a trade is created. We already talked about when your better trades will happen on options. When are they going to be? What situation? Is it going to be buying the absolute lowest penny of the stock? Because I can tell you, you're going to be wrong 5 to 6 times every time you try to call the low or the high. I don't care who you are, the best traders in the world will be wrong 5 or 6 times before they're finally right. It's just the best traders in the world will manage their loss with a very quick and unthought about stop out. The average Joe, somebody coming into this chat room, will be wrong and will still hold and hope to get lucky. So when is the better trade for options created? Moss had it right with his post above. There we go, the breakout. So right now we shouldn't be making an entry just because you started going up a little bit. We should be identifying in this and saying, you know what? even up to this green line and down to this red line, I've got a pretty tight channel. It's still under $1. But regardless of where other swing high points might be or swing low points might be, if I break consolidation, consolidation in itself gives you a very healthy level of support or resistance. If we fell down below the consolidation, that consolidation range would serve as our resistance. If we broke above it, it would serve as our support. And if you watch options prices when you first start making the breakout, either above or below, what happens to the premiums very shortly after the break happens? What do? There you go, Stephen. They inflate. They get a little pop on them, don't they? It's like, you know, you could trade calls here and all the way up to here, they might barely move. Man, as soon as you cross that line, whoa, what was that? That's like when you're watching it, and then it crosses the line and you're like, should I buy? Should I buy? Oh crap, they just ran like another 15, 20 cents and the thing barely moved. That's why you be prepared to identify here where your signal to buy might be. Now here we actually come up, we cross above that prior swing high. We have a double bottom, so we don't need to mark another swing low. And we're right here at that higher breakout point we talked about. What the heck did I just do? So now here, we should be looking to do what? Buy calls or go long in the stock, right? Now for somebody that's just scalping the options, you want to make your support or your stop the breakout point. For somebody that understands that stuff that makes higher highs has a high tendency to still make a higher low, if you're not trading something that expires that week, you can let it wiggle a little bit. As time goes on, is this here a visible down move? Timothy, no, that's what I was saying about consolidation. I wouldn't necessarily look at all of these points here because consolidation in itself serves as a very strong level of support or resistance. So I believe wholeheartedly that it's worth making that trade. Now, will every single one of them be a winner or a big winner? No. Let's not fool ourselves. If there was any trade system out there that guaranteed you'd never have a losing trade, I would have made one video lesson day one, and every night of the week, it would just be playing here in the chat room for you because there's no reason to discuss anything else. But on our swing point here, we are simply buying the breakout. Now here, the very next candle or the very next 15-minute time period comes down a little bit. Is this a visible down move? One candle went down a little bit. I don't think so. Even here, it's starting to look like, okay, that's looking more like a visible down move, right? Now I'm starting to see, hey, that pulled back for about an hour or 4 candles. So, you know, at this point, I want to mark my swing high. And I like to color my swing highs green. Do I need to mark this as my swing low yet? No, because it only went up for one more time period, it doesn't mean it's going to keep going up. Oh, look at that. Oh, started going up again. Is this here a visible up move? One little shark's tooth of an up move? Absolutely not. Now, is this a visible up move starting? I would have to agree so. It's already made up more than half of the down move. Therefore, I would take another swing point, another horizontal line, and mark it at this low. Now here, we actually break above that swing point again, that swing high line. And we start to come back down below the prior swing high. Do you know what this would be right here? We broke the swing high, and the very next candle, we came back below it. Do you know what this would be here? What would you do with your calls trade here? You see, the last time it broke a swing high, it gave you a hell of a move right away. Gave you a pullback, but it still gave you a higher low. But here, when it broke your swing high, it did something different, didn't it? It did something different in the sense that here, when it broke your swing point, it kept going. Here, it broke your swing point and said, If it changes what it's doing, you should change what you're doing. Meaning if you're holding calls and it changes what it's doing, maybe you should change what you're doing and not be holding calls. The problem with a trailing stop there is, I mean, what size trailing stop do you use? Because chances are, as soon as it comes back below the line, that little bit of inflated premium you got here is going to dissolve so fast that, let's say your contract price was $1, 10 cents won't do you any justice. 20 to 25 cents might, but then you're giving up a lot. Where it may be better to just say, you know what? That was a good trade, wasn't it? I entered it Wednesday morning. It comes up. I let it pull back a little bit. It pops, but it didn't continue. So I'm out Wednesday afternoon. And I can tell you that trade right there was one I actually made here in the chat room last Wednesday afternoon. It was 135%. I did it using a different system. I did it using our Fibonacci extensions that we talked about in last week's lesson. But it identified the exact same move. Now, are we making a visible down move here? And we broke back below this other swing high. It is very important that you delete that prior swing high. Why? It didn't serve with any relevance on your chart. Meaning the chart ignored it going up and coming back down. So it has no relevance to us. Delete it. And now that we've started making a visible down move, do we need to play puts on this down move? You know, 1 out of every 5 or 6 times that you attempt to call the high, you'll be right. But in reality, even though it wasn't by much, this stock made a higher high, didn't it? From this right here. We saw before, we had a line right here, it broke above it. We're also making higher lows. If we want a higher probability of producing winning trades, are we even looking at short or put trades right now? Absolutely not, because let me tell you, if you tried to call that high, you weren't right. If you tried to call that high, you didn't make no money before you got obliterated. Calling either of these little highs, you could not have made any money. So we have to wait. What should our expectation be for the next low? It would be for it to be a higher low. So that's why we wouldn't want to be taking a puts position for that. Now, is it guaranteed that it'll be a higher low? No, it's not. No, it's not. And this next little bit of this chart is where it's really, really important for you to understand what the statement I made just a little bit ago, that right now we are not talking about the 50-50 trading system. Does everybody understand that? I want to tell you, the reason we would have bought calls here is because we had not been making lower lows, had we? We had a low, a higher low, a double bottom. We did not make a lower low, right? Which give us the ability to make the anticipation or the assumption that we would make a higher high. So as we broke out, what we had going for us is even if it didn't go straight up from there, that it should then at that point still make a higher low. And on a W pattern, we'd say, well, they could just retest the W and then get going again. So we right now should be anticipating a calls play, but because of the higher high, do we take puts instantly if it makes a lower low? This is where you get variations between swing points and the 50-50 trading system. The 50-50 trading system, if it breaks below that red line right there, I'm buying puts. Swing point trading, no. What did it just do here? It made a lower low on what I would call a pretty intermediate move. Now, let me tell you why I call that an intermediate move. It is a statistical fact that 85% or more of stocks will pull back or go sideways between the hours of about 11:30 and 2. Well, here's 10:30. And right down here, it's coming into 3 o'clock. But this is that midday time frame. And what's the stock doing? It's going sideways. The actual move you need to be able to identify here, and why you don't necessarily take puts right away right there, is that this up move also started down here, didn't it? This is really all one big visible up move, is it not? Now, as I start to go up here, it's obvious that I broke below this swing low point, right? No longer holds relevance on my chart. Therefore, you have to delete it. I'm starting to make an up move, but do I really have enough to say it's a definite visible up move? Nope. So here's what I have to tell myself at this point in time. This kind of sucks. But just like down here where we had a range that we didn't want to trade it in, right here we kind of have a range we don't want to trade it in. Why? because it's given us mixed signals. We had a higher high and a lower low, right? Which means our next trade won't come until what happens? A breakout. If it comes down now and goes below this line, that's good cause for a puts trade now, not before when it was coming off a higher high. Or if it breaks and makes a new high, that'll be good cause for your calls trade. What did it just do? It broke out, much like it did right here, right? Now, you could sit and look at it and try to convince yourself that every up move is just another chance to buy puts. But truly, that's not the case. Right here is your opportunity to make a calls entry. And really, there's a couple ways to do that. Granted, you could wait for the whole 15-minute period to carry out. Some people would tell you to go right when you see it break. For me, what did I already state to you was more important as far as a value made during a candle's period. I want to let it close. Now, just so you know, letting it close does not guarantee I'm going to produce a winning trade. But what it does is allows me to watch that candle close and see the movement on the next candle. It went up, it spiked, it started pulling back a little bit. Is this a visible down move? Is it starting to look like a visible down move now? I would still say no. But in this case, where I had an entry qualified by the closing price, should I be looking at puts just because it came down a little bit? Or should I say, I've got to look for my opportunity to buy calls? Once it qualified on the close of that candle, anything price-wise that comes close to here, I should view as an opportunity to buy, right? Or if it does what? If it does what? I've already got my qualifier to buy. I just haven't bought yet. So I can either get it as close to this line as possible, or I need to get it when? If it goes up any higher than where my qualifier was, right? I was already qualified to buy it there. So if I see it start to pulling back, shoot, any price I can get it at is going to be a good deal. But man, if it goes above there, I don't have to wait for a close. It already qualified as a buy for me. So without even waiting for this close, I probably should have been buying. Now, in this particular case, is this a visible down move? I mean, it's 15 minutes right there. So at this point, we're actually still making the same visible up move, aren't we? You got to ignore the little price bubble. That's kind of a little cheater. Let me get rid of that. Now here it started to pull back a little bit. Is this a visible down move? No. Really isn't. I wouldn't even say this is a visible down move because it's pretty much the same little shark tooth it did here, or even like the little up move here. You know, now that we're looking like we're about 3 candles into this, we might be having a visible down move, I think. So I'm going to go ahead and mark my swing high. Okay, so we're starting to go up. If we go up and break from here, would this be a higher low than this one? Yeah. And are we starting to really make a visible up move now? Again, a few candles now into that. Now, I wouldn't recommend taking a puts trade if it fails below this line right away. Why? Because you've still got a chart making higher highs and higher lows. But I might want to use this line as what? This red line. No, I wouldn't even use that as another calls buy. We're talking about the one buy that we're in. Stocks don't go straight up or straight down. So I make the buy. Okay, it's got to relax a little bit. Now we're moving. I already suffered through a down move, didn't I? Should I have to suffer through another down move? Unless it makes a higher high? So here we are back down at that same bottom point, and here we go below it. What should we be looking at here? I'll agree with the swing high. And unlike that last time we went below the red line we had right here, what just happened? We had a lower high already, didn't we? So the necessity of both a lower high and lower low before buying puts has actually now been met, hasn't it? Now here, if you actually look, that dipped below this prior swing high line, meaning it did not serve as the support point. So what should we do with this green line that was here to maybe be a potential for it to bounce off of? Gonna remove it. Is it possible for the stock to still make an up move from here? If for no other reason than the fact that it just fell pretty good? Are we starting to make a visible up move? So we'll mark our swing low. Do we need to sell puts that we took right here just because it bounced once? No. See, the people that do this, they say, oh, I'll just sell and buy at a better price. And then what ends up happening? Every time they say, I'll sell and buy at a better price. For some reason, they have an excuse as to why they didn't buy it, right? What should we be looking at as our next high? Should it be higher or lower than this green line? Should be lower. The first move while you're in a trade is the most dangerous aspect of that trade. You ever notice when you're in a trade, you're really nervous until it really starts doing what you thought it would? And then sometimes it's like, okay, I'm in puts, it's going down. Oh crap, there's a little bit of a bounce. Okay, I'm falling again. Once it starts falling that second time after that first bounce, you all of a sudden feel pretty good about it, don't you? Or with calls trades the same way. You enter calls, it starts going up a little bit, but then it pulls back and you're like, oh crap, oh crap, oh crap. But then it starts going up again. You're like, whew, now I'm good. You ever notice that about your own trading? I do about mine. I don't need to try to keep secrets from myself. Is this a visible down move? Well, it obviously is now because it spiked right down through there. So we're going to mark our swing high. You see, if you just randomly sell right here, in all reality, sometimes you might be right and have gotten a good sell. But see, the other aspect is all you're doing is expecting a lower high, meaning any price below this green line. Well, do you know exactly what price that will be? I mean, I could throw a bunch of bull crap and try to guess on my chart, but do I really know what price that'll be, or is it just any price lower than this one? Got a whole bunch of these little shark's teeth. Oh man, it just dropped below that one too. Am I glad I held? Am I glad I held through that first bounce? I am. I don't know about you. Now, there's two ways to look at this point. If I'm trading on the 15-minute chart, chances are I'm trading options that expire this week. I already let it. I gave it that one bounce. Do I want to give it another bounce? For me personally, no. Just like when we were trading the calls, right over here where it went a little bit above a point and then quickly came back below. Let's look at something. Remember when we had that discussion just a few minutes ago about how when it broke this high point here, unlike where it broke this swing high and went straight up, here it did something different, right? Well, let's look at something. When it broke this swing low, it stayed below it, right? And when it broke this swing low, it stayed below it, right? So if it does this, where it just closed above this swing low, is it now doing something different? Is it now doing something different than when it failed this swing low and when it failed this swing low? It is now doing something different. So that means I need to do something different, right? And if I'm holding puts, what would I do that would be different than holding puts? I would sell my puts. Now, the fact that we dipped below that swing low and came right back above it, Does this swing low have any relevance on our chart? No, see, Flyer, considering calls here would be the times where you just kind of get lucky when you just get lucky if they make money. This line has no relevance on my chart. I'm making lower lows and lower highs. If you want to be in that group that's wrong 5 or 6 times before you're right once, you would try to buy calls on any little shark's tooth move like this. Is this now a visible up move? I mean, I don't mark the swing highs on these shark's teeth, but kind of did visibly go above that, right? I say we mark our swing low. Is there anything whatsoever on this chart telling me to buy calls? But hold on, it's up 20 cents from where it bounced. I could have made like 6 cents on a calls trade. What am I still expecting here? A lower high. Lower than what? Tim must take karate. Lower height. Lower than this high, which actually means it could go up quite a ways. Does it have to? Did this high come clear up here? Was it only like a penny lower there? So I can get a value trade by looking for puts if it comes anywhere lower than this green line. But if it does what, I'm still qualified to make an entry. If it does what? Makes a lower low, right? Because for puts trades, I can try to guess a lower high. But if it makes a lower low, I got to look up and say, yep, that was a lower high. At this point, we still have not done that. At this point, what did we do? It's a lower low. So we would have to do what? One of two things. Go, man, Coach Mike, why'd you tell me to sell my puts here? Because you were already up considerably. And that's what the trading system told you to do, not Coach Mike. We'd also want to mark that as a swing high, wouldn't we? We'd buy puts, and if we're in puts, this green line is our what? It's our stop. Okay, so now we're back to that whole series of, well, except for this one little iffy time. Every time it broke a swing low, it kept going down. And if it changes that, we don't want to be in puts. Well, we're going down, we're going down. Okay. What was that? What just happened here? This little dip was one time frame's close, and then it started to go up. On the way down, prior swing highs serve as what? Support. And on the way up, prior swing lows serve as what? Resistance. Very non-traditional from what you might have found out at Stupid Nova, where you use that one wee little wick that was probably a fat finger trade way up above something. That's your resistance, right? It has to go there. Now, this one candle that popped up here, is this really signifying an up move? No. Now here, you had the one candle that popped up. Now you're kind of going down a little bit. Is it really signifying a down move? No. What's happening here? Well, the way this thing moves, now all of a sudden it looks like it's bouncing off my support. Now, there's a difference in entering a strangle just for the hell of it and entering a strangle when a trade system calls for it. Let's see. We bounced off a swing high. A prior swing high on the way down serves as support. My assumptions in trading are support will hold. If they fail, that gives me another. So it kind of made a little bounce. And even though I wouldn't mark these as swing points, this little down one wasn't as far down as this one. And now I went up higher than this. I still don't have a reason to exit my puts, do I? But if it's possible that I might lose money on puts, I might want to do what? Buy calls. You see, I didn't just randomly say take a strangle on every one of these little shark's tooth. You'll go broke that way. Here, right here, this candle, when it popped up to 78.80 at 3 o'clock on 2/27, that's when you get your call strangle. Why? Because at this point, you haven't been given an exit on your puts, but you have been given an entry on calls. And if you're going to lose money on your puts, you might as well start making money on calls, right? Well, still no exit on the puts. Would you actually say that an hour into this move, this is a visible up move to this little shark's tooth right here? This isn't a one candle thing like this. This is an hour since it hit that swing high point. Now here, remember when I put this swing low point here and I said I wasn't going to buy calls just because it bounced, here and started going up. It's just kind of to help me out with where I'll justify a trade. Many, many times you'll see this at the top and bottom when a stock hits a top or a bottom, consolidation time. But many, many times you'll get an indication that the consolidation might end. Right here. What is this in relation to this? A higher high. And even though it's still fairly safe to say, I mean, if we're going to use shark's teeth, we might as well put a little line right here. And even though it's still fairly safe to say that we could still be consolidating, we got a higher high, which means we should look for what? Higher low, which means any pullback we get after this point is what to us? We were in puts. Stock was doing the same thing over and over and over again. Now it's not. We bought puts because stock was doing the same thing. If stock no longer do same thing, we no longer hold puts. So at this point, any down move, you shouldn't be saying, maybe I can get a little more. Maybe I can get a little more. You have to say, it already told me I have to sell my puts. Where do I sell them? If it breaks above that line, or on any down move is going to be my best opportunity to sell. Let's start looking a little bit here. This one you might not be able to see it, so let me go one more. Uh-oh. Two things I need to do here for a swing point chart. Two things. What should I be doing? No, we already did sell. We were selling on any down move it made. You didn't even have to try to catch the low. It pulled back a little bit. It told you to sell any resemblance that it was going to go a penny higher than where it's at right now. You sell. You're already in calls because it bounced off the swing high. Okay, that's one thing we need to do. It did close above that swing high or that swing low. No relevance on the chart anymore. One other thing we have to do. What is it? I need to delete this swing high point and replace it with a swing low. We already bought calls, Amy. We bought calls when it made this bounce here off of that old swing high right here. Why do I want to replace this with a swing low instead of leaving it as a green swing high line that it just was? It's not just my stop. It's actually going to tell me that, you know what, this thing already retested that swing high. So I don't want to confuse myself into thinking that if it goes down there again that I should buy calls. Because if a stock is going to continue making higher highs and higher lows, you see, even though it might look to somebody whose mind cannot wrap around anything but what's happening right this second, it might look like this stock has fallen apart. But in reality, from where this one up move started, from this low to this high, we just made what? From this low to this high, oh my Lord, we made a higher low. Didn't we? At a point where we retested a swing point. So I don't want to leave that as a line that might tell me to buy calls, because I already bought calls off of that line. And if I make multiple buys off of the same line, what am I doing? If I make multiple buys off of the same line, what am I doing? I'm increasing the risk I have should it consolidate. If you're making one buy because it hit a line, okay, every trade you make, there's a little bit of risk in it. But it gets a hell of a lot more risky if I buy 30 times off the same line, right? Because there's probably a reason it can't do anything but keep hitting that same line. So here, am I still in calls? Okay, now this, you see it starts to go down a little bit. That's not really a visible pullback though, is it? But here it looks a little more visible as far as my calls go to do what we've done every other time and say, you know what? This would not be a puts buy if it falls below there because we just made higher highs, right? But it would be what? Would not be a puts buy to fall below there, but it would be what? I already held it through one pullback. if it did something different and pulled back lower than that point, I would want to do something different. It would be my stop out for my calls. And right here, exit. What else do I need to do to my chart here? Two things that have to happen to my chart right here. We went below a swing high. Bye-bye. What else do I do? I've got to mark my swing high because I now have a visible down move. Am I buying puts? Right here. Would have been a little different if it came up maybe to a prior swing low, or maybe even came like up here and started pulling back. It's like, wow, that's a lower high. But remember, the swing lows serve as our resistance. So if it would have hit here and pulled back, that's resistance. Just like where we bought calls off a retest of a swing high. Do I buy puts right here? The inability for people to give an answer is why I don't do a lot of day trading with the chat room. You have to be able to think quick. If you can't think quick, that's the first sign that you do not need to be day trading. This is not a puts buy here because we had a higher high, right? Now we got a lower low. Well, crap. What do we do when that happens? We got a higher high and a lower low. What do we do? We got to wait. That's the answer. We just wait. Now this is starting to look like a little bit of a double top, isn't it? You see, I would not have marked this hump here. I also wouldn't have marked it here. But here, I would have said two things. Visibly, this thing has hit the same top point twice, hasn't it? Did it not visibly hit the same top point twice? Now see, Amy, that's where you're thinking like the 50-50 system and not like swing point trading. But I did have a visible up move from this low, right? So I want to mark that as a swing low. Is this low higher than this low? And this low here was higher than this low down here before this one big visible up move, right? The reason I would have marked this when it hit that second time and kind of pulled back from it, because plain and simple, if it breaks that, it'll be doing something different, right? Plus, if you really got technical on chart patterns, it's an inverted head and shoulders. If it breaks, you guys see that? Can you quickly identify inverted head and shoulders? Left shoulder, head, actually that'd be right shoulder for this, head, left shoulder. Does everybody see that? If a head and shoulders is considered the most bearish of all patterns, what do you think inverted head and shoulders would be? Pretty bullish pattern, right? So as I start to identify that and say, you know what, I wouldn't have put that line there at first, but when it hit it again and pulled back, there's some relevance to that line. You kind of have to. Statistically, Ryan, they are more bullish than a W. They are the most bullish of all chart patterns in inverted head and shoulders. Now, that just means that they've got a higher consistency of giving an up move. Doesn't mean that it's guaranteed to go to all new highs just because you see it. But here, what do I want to do? And this is where I'm going to confuse you. What is this red line? What is this red line right here? Okay, and swing lows serve as what on the way up? Resistance. So here is how this would be traded. You've already got the qualifier to buy calls when it closed this candle above your neckline for your inverted head and shoulders, the double top. You made a break of a prior swing high, so boom, there's your qualifier. Now, if you get too technical, you're going to forget your assumption of resistance won't be broken. And when it is, when our assumptions fail, what happens? See, again, most people make assumptions that create trades for them. That leads to most people failing in the markets. Our assumptions here make us wait for trades. And when the assumptions fail, it creates what? A trade entry. We already qualified to make the trade, but we have to assume we shouldn't because resistance is right there. Do we have to wait on a candle to close above the red line, or are we already qualified to buy calls if it moves past the red line? All it's got to do is move past it. It doesn't have to close. You're already qualified for your entry. You just don't want to make literally a 7-cent trade, right? So if our assumption fails, we buy. Did you see what happened there? What happened? Look real close. Zoom in if you have to. It hit it and pulled back from it. Now on this chart, a 15-minute chart, from this break where we qualified for the entry to another 15-minute period, and now the third 15-minute period, how much time has gone by? 30 to 45 minutes, right? If we went with the close of the candle, it's been 30 minutes. 30 to 45 minutes is what? Keep it simple with your answer. Don't overthink it. Time. Options traders. Do we have to think about time? Yes. Do we still have a qualified reason to buy calls? But we just want to wait for it to break that red line. That 45 minutes on a Monday might have only saved you 5 cents. On a Friday, it could have saved you 30 cents. So did we have to wait for this candle to close, or did we buy it when it crossed it? Buy it as soon as it crosses it. What do I have to do to my chart now? Now let's really think about this. We've talked about this a lot with this. When we've broken, even right here, it broke this swing high point we've got marked. Did it ever come back below it as of yet? When we talked about the swing lows here, it broke below, but if it does something different, that's when we do what? We just made our calls by. If it does something different, meaning if it breaks a swing high and doesn't keep going up, we do what? Sell. We don't say, well, what if? What if it keeps doing something? So here we go, here we go. Okay, we broke our swing high. What should it do right now if we're going to stay in the trade? What does it have to do right now for us to stay in the trade? Kind of looks like back here, doesn't it? We barely broke that one swing high point, and then it fell. What do we have to do? Bye-bye, right? Bye-bye calls. What else do we have to do? Remove this line, right? We do have a visible down move. That's a pretty abrupt down move. So we're going to mark our swing high too, right? What just happened? Yep, fell below this swing high. Now, some people should say, well, why didn't we buy puts there? Who's asking that right now? Why didn't we buy puts? Look at that big drop. Same reason we didn't buy puts here. It made a higher high. We have to assume that it's going to make a higher low, but it doesn't have to. What happens right here? It just went below my swing low point. It failed my swing low. What do I do? No. We don't buy puts here. Again, let me reiterate. We're talking about swing points, not our 50-50 system. What do we do here? Why would we change the green line to red? It actually closed about 3 cents under it. We wait. Thank you, Ryan. We wait. Why do we wait? We had a higher high. Now we got a lower low. Now we got to see if the next high is higher or lower. Sometimes you have to wait. We're talking about systematic trading. We're not talking about what if or if you guess right one time. We are talking about systematic trading. Here, your green line's got to go bye-bye. Why? Because it went below it. What do we do here? You got one up 15-minute period. What do we do? What about now? How about we delete the red line? It closed back above that. And we probably want to mark this one, right? Now I want you to think about something real quick. Visible up and down moves. There was a bunch of little up and down moves here, right? From this low to this high. there was a bunch of little moves, up and down moves, right? But visibly, it went from this low all the way to this high by making higher highs, right? And then in its process of making lower highs and lower lows, it came down and started making higher highs from a point higher than it started the last move. Bullish or bearish? Then, even though there's a couple different visible moves here, in reality, it made one up move from here that it continued making higher lows and higher highs to here, correct? This is one visible up move. And this down move would then be what? Another higher low. Does that mean we got to buy calls? No. Does it mean we should be looking at puts? No. Man, we just went below this swing low. We're sitting right at this low. So let's think about something for a second. Now it's starting to look like it made what? A lower high. And it's sitting right at the point that would actually be what in relation to highs and lows from the last visible up move? Double bottom. If I get higher lows, what are my expectations of my highs? What are my assumptions for my highs? If I got higher lows, I assume I'll get higher highs. If I get lower highs, I'm assuming I will get lower lows. If I get equal lows, I'm assuming I will get some people need to learn to type equal highs or a double top. If I get a double bottom, I've really got to assume I'll get a double top, which now means I have what to look at? This was all one visible up move. And now we are visibly making a down move. If I were to bounce here and start making an up move, I would assume that I would trade to what? This high. This was the low that caused this high. So if I double bottom on that low, I would expect to double top on that high. So now I need to think what? What do I need to think right now? If I got a double top or a double bottom and I'm expecting a double top, that would be the definition of what? Starts with a C. Consolidation. A point in when the chart makes multiple highs and multiple lows within the same price range. If I identify the potential at consolidation as an options trader, what must I do before I trade it? Wait for a breakout or identify if there's how much room between the low and the high. Options is a game of $1 moves. So my low line's at 78.70. My high line is at 79.84. Is there a $1 move to be traded for? Yes. So if and only if I do what on the next candle, now that I've made a double bottom, I will buy calls for the $1 move. Not a $20 move, not an, oh my God, it might go to all-time highs. For if it hits this green line right here and starts to even act like it wants to pull back, I sell. What has to happen before I buy my calls? Yeah, you don't want to try to call the low. You want to see if it moves positive from the low. Ah, shit. What do I do? I just spent all that time planning that darn calls trade off a double bottom that even though I identified it could just be consolidation, now it's no longer a double bottom. And did I catch the lower high to make the puts trade on? In reality, even though I'd look back here and say, well, technically, because back here you'd say, well, we didn't catch that, but we caught it right when it broke below this line. Well, that means it was when it broke below this line. Now it's already down almost 30 cents from that. I missed that trade, didn't I? I missed it. I did not get it at the point where it broke below this line. Why? Because I was looking at the double bottom potential. And that happens, and it's okay. Now think about what I've talked about the visible up and down moves, not just the one little one, but the entirety of moves. What must I do now? On the little moves, yes, I had a lower high and a lower low. On this one visible up move, I came down, made a higher low. Now this came here and made a lower high. What do I now have to do now that this made a lower low on this visible up move? I have to now wait in anticipation for a lower high. With this trading system, I have to wait. I can make stuff up and maybe make some money. But with this trading system, I have to wait. What high am I expecting to be lower than? Is it A or B? B, that is correct. Why? Because that's the visible move that we just made the lower low from. This is a little move. We'll call this a minor. And this would be a major, right? It was a series of higher highs and higher lows that made one visible up move. And this is individual lows and highs, right? Major, minor. I can still make trades on the minors, right? And I can also make trades on the majors. Okay, right here, it come back above this red line. What do? We're going to remove that one, but we're going to mark one right here at this bottom, right? What's funny is it kind of came up here and acted like it might want to pull back. If we were talking 50-50 system, we might be buying puts right there. We're not talking the 50-50 system. Shoot, now it broke that red line. I still have to wait. If I'm trading this system with the consistency that this system can give you, I'm still waiting. Now, I can get like we just talked about majors and minors just as an easy way to categorize them. If I make a higher high, then I would still have to do what? Because I made a lower low as far as the minors go. I'd still have to wait. We're not holding anything. Right now, we'd actually be out. We don't have a trade. There is no one system that's going to call out every single trade on a chart. But there are systems that can be productive in making sure that the trades you do enter have higher probability of making you money. What just happened? We got a higher high, at least from this one, right? But in reality, we're still coming off of a lower low. So we got to wait. And remember, because of this lower low, this indication that was given here, what are we waiting on in relation to this green line up here? Essentially a pullback anywhere lower than that line would be our lower high, right? So if it started going down tomorrow, because look at where we are on the chart. Let me back it up. I'm just going to go to the 5-day, 15-minute. Here, we're ended. We are at today's market close, March 3rd. If tomorrow started going down, would it be a lower high in comparison to this? But is it possible, though, that it could kind of trick us, start going down, and then start going up, but we'd have to kind of hold it all the way to this line? Because any high lower than this line is a lower high. And we have to make that assumption. It's going to make a lower high. That's my assumption. So what happens if it breaks this line? Assumption failed. What happens when our assumptions fail? No, I'm saying let's say tomorrow it actually gaps above that line. We're not even holding anything. It gaps above the line, higher high. Assumption failed. I assumed it'd make a lower high. When the assumption fails, a trade is created. Just like back here, it made the lower low. We waited, and then it actually gapped up. And that was the buy. If the assumption fails, a trade is created. Now, when I look at this 15-minute chart on the mountain chart, is it pretty easy for people to follow along and see the visible up and down moves in the way that we mark them together? Do you ever struggle when looking at the candles to identify if something was actually a visible up or down move, or if you're just marking every green and red candle? If you struggle with that and you just said yes right now, at least 2 of you are being honest. I know probably 4 more of you should be honest with yourself based on the emails that I get about swing points. What type of chart do you think you should use if you just said it's easier to see on this chart than it is on a candle chart? You should use the mountain chart. Because when I do this, hey, this crazy spike was not on my mountain chart, was it? Did you see that? Friday at 9:30 in the morning? Let's go back to the mountain chart. Hey, wait a second. Friday, 9:30 in the morning. There was a big spike here, wasn't there? And little anomalies like that, do they confuse you? Those little anomalies are probably the #1 cause of people not seeing swing points properly. So if you cannot look at a candle chart and easily identify these exact lines that we have on our chart and understand why they are there, use the mountain chart. It's not like mountain charts are bad. If you watch Mad Money or Fast Money or most other shows that talk about stocks, what kind of chart are they showing you? Do they ever show you this chart right here? You either get the line or a mountain, right? And all the line chart is the mountain without the shading. That's all it is. But as far as swing points go and the consistency of a system as opposed to, well, maybe I'll get lucky. Obviously, right here on this break, there could have been some money to be made. But that doesn't mean it's a higher probability to make money. In all honesty, if you were making this one, you definitely wanted to sell it by the end of the day. And that's why it would have been a decent trade because, hey, at the end of the day, you were up from that line. But you still have that assumption that you're going to make a lower high because we made the lower low on our mountain chart. And you might say, well, all it did was bounce off of that swing point again. You know, first time we bounced off of this W, now we bounced off of this one. Yeah, there's a whole bunch of what ifs we can put in there. But I'll tell you this, if it breaks above this green line right there, it's a calls buy. And if it pulls back from any price below that green line right there, it's a puts buy. And then if it does anything else otherwise, it'll tell you what to buy and what to sell. That I promise you. Trading is not about buying the absolute low and selling the absolute high. It's about being consistent with something over and over and over again. Very, very simple. Find a system of trading that you're comfortable with. And then before you start throwing your money at a chart, test the accuracy of that system on that chart. Because not every chart will be consistent with every trading system. That's why Coach Mike spends so much time talking about so many different trading systems. because he has taken the time to study them on many, many charts to find out that, you know, on one chart, Fibonacci extensions works better than anything else historically. And on one chart, swing points work better than anything else historically. So as of right now, if you're looking at Facebook for tomorrow, March 4th, what two possibilities on this 15-minute chart do you have? Well, no crap, Joshua. How about something a little more descriptive that says that if it does happen, you might actually be prepared to make the trade? A pullback from any price below this green line indicates a puts buy, does it not? And a break of this green line indicates a calls buy, correct? So now we have the one question a lot of people are going to ask. What do you think that question might be? You told me how to trade the system. You told me how to mark my chart. You didn't tell me what? What strike? I did tell you when to sell. We went through several and talked about when to sell. But what strike? That's the important part. What strike? You know, when I talk about like Fibonacci extensions, I talk about an actual point you can see on the chart that's got a price attached to it. And we want to trade something that goes in the money by that price. What do you think we want to trade with swing points that would still be consistent with how we trade Fibonacci extensions? And before you answer, I want you to think of it this way. The reason we use the 100% line as our strike price, or just a price that we're going to take calls below that 100% line for fib extensions so that they're in the money should that line be hit, that line is actually what in relation to support and resistance? That 100% line for a calls play is what? Resistance. For swing points, on the way up, what serves as resistance? A prior swing low. So if we break this green line, this red line is resistance, right? So we'd want to trade like the $80 call. But what if it gaps above 80 bucks and it breaks that resistance? Then that means this red line. And we could take the 80-50 call. But if it hasn't already broken this red line and you make your buy, you better trade the $80 call if it comes up above this green line. Because that will be your higher probability at producing a quality trade. And you could say, but I could buy a lot more of the 80-50s than I could the 80s. And I'll say you could lose a lot more on the 80-50s should it just hit this red line and turn back around. Because the 80-50s or the 81s or the 95s would not be the trade to make. And then you could say, but what if it does go up there? Well, you know, what if Aunt Sally had in her pants what I have in mine? She'd be my uncle. So let's play the what if game all day long and see if we get anywhere. Or we could trade systematically using systems that produce a high percentage of winning trades. And then by doing that, we eliminate what? Or if we don't eliminate it, we at least severely reduce it. No, I'm not even going to say the risk. There's a risk in any trade. People properly mitigate risks with their position size. You never put your whole account into something. Human error. And in trading, what's the leading cause of human error? And emotion is caused by what? Thought. There we go. When you think, you fail. I can't tell you how many times, whether it be swing points or like the 50-50 system, somebody goes, I get an email, it just doesn't seem to be working for me. And I'm like, well, tell me about your trades. And they say, well, I was trading Apple like 3 weeks ago. And I didn't think it could keep going up, so I bought puts on every red candle. I didn't think it would keep going up. And now I'm broke because I was thinking. Because right over here, yeah, it gave you a false indication. It told you to buy puts. Guess who bought puts? Coach Mike. Yep, following systematic trading. Guess who bought calls right here that sold for 300%? Coach Mike, because I was systematically trading. Right over here, it told me to buy puts, and guess who bought them? Coach Mike. And guess who bought calls right here, systematically trading? Coach Mike. Don't think. The extent of your thought process when using a system like swing points. Did it cross a line? Check yes or no. And then react based on what it did. Went above a green line. Well, I guess I got to buy calls. Came back below that green line. Oh, shit, I guess I got to sell those calls. Why? Because you could either lose a little bit or you could maybe lose a whole lot. It's very simple. Don't think. But if you are thinking, it's probably because you don't trust the system. Why don't you trust the system? Because you heard a good story one day and you started throwing your money at it. You don't trust it because it hasn't done anything for you yet. Practice with it. Use a paper trade account. Follow it for a while. Study. Once you trust it, trade it without thinking about it. Period. End.